Hello and welcome back to the Fixed Income Outlook series. I am Devang Shah. Today in this video, I will take you through the summary of macro events for the month of July 2024. The impact of all those events on markets, strategy for our portfolios and the outlook for markets. I'll also try and cover the risks to the view and opportunities for investors. The month of July generally for our bond markets was very positive. The weak economic data in US economy, the positive demand supply for bonds in India, China's surprise rate cut, weak oil and commodity prices, and finally the fiscal consolidation in the budget led to lower yields and the yields trending lower to 690. Banking liquidity, as I had highlighted last month, turned out to be surplus and the overnight funding rate eased massively from 665-670 band last month to 640-45 range. The macro data for India, especially CPI, came at 5.08% versus an expectation of 4.8. It was a tad higher than expectation, and all the increase in CPI was on account of food and vegetable prices. But we didn't see any significant rise in yields as core inflation continued to behave well at 3.1%. And the expectation of the next prints, specifically in this quarter, is significantly lower, and July print might be at 3.4% due to base effect. The huge increase in banking liquidity because of RBI dividend and FPI flows over the last 2 months, RBI started doing small amount of OMO sales to the tune of 7,000 to 8,000 crores to neutralize some part of this surplus liquidity. The impact of these on bond market yields was very muted and insignificant. Budget continued on its path of fiscal consolidation and policy continuity. From a bond market perspective, there was no significant deviation from the interim budget numbers, both in terms of spending and the borrowing numbers. Hence, the price reaction post the budget on bond market yields was very muted. In this month, RBI also released a consultation paper tweaking some bank LCR requirements, which, if implemented, would lead to additional demand for liquid assets, specifically government bonds, from next year to the tune of 1 to 2 trillion, which is very positive for bond markets. Month ended with the Fed status quo policy, which also has guided the markets. From September onwards, we might see Fed rate cuts and would be data dependent. INR as rupee is trading at all-time high levels, but our high reserves, strong FPI flows to the tune of 7 to 8 billion for the month, and weaker commodity prices, we don't expect any major depreciation in currency. As explained, Indian bond market yields rallied by more than 10 basis over the last 1 month. In fact, US 10-year bond yields are down by more than 35 to 40 basis. With the ease in banking liquidity, the yields on the short-term money market curve also saw a rally of 10 to 25 basis. In this month, specifically August, I think all eyes would be on RBI policy, where we believe RBI would stay put on monetary policy rates. Due to the weak macro data, US yields have started pricing in more than 150 basis of rate cuts in next 12 months, starting from September 24. But I still believe Indian bond markets are not pricing in any significant rate cuts till March 25. Our belief is weak CPI data and weak US data, along with positive demand supply dynamics for bond markets, would lead our Indian bond yields to slowly and gradually trend over to 675. The strong growth, specifically the high frequency indicators, continue to remain very strong, and the monsoon uncertainty will keep RBI cautious in the August policy, and we don't expect RBI to be in any hurry to cut rates. US bond market yields will continue to trade in a range of 3.9 to 4.4% as Fed starts to cut rates from September. But the high fiscal deficits in US will not allow massive rally in US yields. Our core view continues to remain constructive on rates due to positive demand supply dynamics, specifically for IGBs. The lower CPI outlook and the stable external sector also makes us positive on our bond markets. We expect a 50 basis of rate cuts in this cycle in the next 9 to 12 months. In anticipation of flows in government bonds due to JP Morgan inclusion and this tweaking of LCR guidelines, our portfolio continues to have a higher allocation towards government bonds and the short end on the corporate bond. Market positioning is very heavy. Both traders and investors are very long, which means I think everyone is positioned for rally in bonds. Any surprises from RBI in the monetary policy, especially on OMO sales or MSS announcements, can lead to some bit of volatility and a rise in 10-20 basis yields in the near term. Investors should continue to hold their duration across their portfolios. Investors would need to be patient for further rally, as further rate easing in India would be delayed to probably second half of this year. With expectations of lower CPI, favorable demand supply dynamics for bonds and continued flow from FPI, we continue to advise short to medium term funds to our clients with tactical allocations to gilt funds. I would thank all of you for your time and keep watching this space for more updates on fixed income. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.